Ciao Andrea Unger, benvenuto allo spettacolo.
Buongiorno a tutti.
Buongiorno, thanks for coming. Really great to have you here, Andrea. And listen, I'm going to dive straight into it. You know what? I got you on the show because I want to make 672% returns in a year in, year out. You're the famous trading champion 4 times, 3 times in a row, 4 world trading titles.
Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field. We hope you enjoy the show, and if you do, please subscribe, leave us a review, or even buy us a coffee via the link on the algorithmicadvantage.com. We really appreciate it.
I'm not sure of the other years. They were also enormous. 672%. Was that in 2008?
Yeah, it was 2008, and it was thanks to the crisis, because subprime crisis, the markets moved like crazy. And obviously, when there is volatility, it helps if you have the right strategies in place. The following years, 2009 was a quiet year, and I achieved 115%. So you see the difference,
Terrible.
And 240 in 2010 and 82 in a 3/4 contest in 2012. So
there we go. All right. So look, the guys and gals on this channel, we all know a fair bit about systematic trading, and we know that it is not normal to make 600% returns. So what on earth did you do? Like, how much extra risk did you have to take? What kind of position sizing did you have to do? What rules did you bend?
A lot. I mean, obviously, I don't achieve 672% every year. I did it once in a competition, and I don't even go close to it in my personal trading. Competition, first of all, you have a small sized account compared to the one you normally trade. I know in 2008, I had $15,000 on the account, 15,100, okay. And it was completely different, of course. I could afford losing that completely. So, I mean, it's not pleasant to lose money, but you know that it doesn't change your life if you lose. So obviously, you trade with a full risk. Full risk means that you try to get the maximum out of the strategies that you have. And there is a maximum, a theoretical maximum, because, in position sizing, you decide how many contracts to trade depending on the potential loss of each single contract. And that percentage of losses that you can afford or you decide to afford has a limit, actually, a theoretical limit. I don't mean, if you say, if I accept a loss of 5% of my account, I can go on. So if I accept a 50% loss, I can achieve 10 times what I got. You might, but there is a limit above which the whole thing is no more profitable. This is the optimal F. I mean, I don't want to go deep in the concept because I don't want to lose the audience here. But let's say more is not always better. There is a limit. If you cost a coin, and you have, if you bet 1 and you win 2, when you win, if you bet more than 25%, you have no longer the advantage you have with 25%. So you understand that you have to find this limit. So given that, you try to go as close to that as possible so that you obviously try to maximize the power of your strategies. The point is always the same. I mean, money management, position sizing doesn't turn a losing strategy into a winning one. If somebody tells you that, he's probably lying. The problem is that you have to have something that works well and then get the best out of that. And this is what I was so lucky to do. I say lucky because you need luck. I remember in 2008, I was so close to bankruptcy in that account. So close because I had an awful drawdown, about 46%, something like that. So you understand the level of risk with 46% drawdown in 1 month, which is not something anybody would like probably. And probably one more losing trade would prevent me from trading any longer because I would have no longer enough money to trade because of the margin requirements. I was trading futures. And so I was lucky because the next trade was a winner. And that winner put extra money into the account. And so I was able to go on and to achieve then what I did. But you understand that sometimes the borders are very, very flexible in the way you live the adventure of trading. So obviously, the fact that I won 4 times demonstrates probably that I have something that works in the underlying. But believe me, I was also lucky because the single facts told me that I had luck. Okay, I could achieve more because I was up 700% in November. I lost money in December. Okay, but it doesn't make the difference. The point is that you need something that works well, and that works well when you need it to work well. And you have one year. 1 year is extremely long because you suffer the competition, but it's also extremely short because you need to perform in 1 year. You can't make money back next year. You can in your personal trading, and you're happy to, but when you have to win the competition, you have to do it within the end of December. And so you need it to be done on time, and that needs also a good portion of luck. And I believe that anybody who is serious and won the competition will confirm that. I know you have some very nice guys on your podcast, and I know some of them. And talking to them, they also confirm that, of course, they have good stuff, but they also had luck.
Yeah, and it's not. There's some statistical significance to winning 4 times, I would say, but obviously you have to really push the risk and you have to push the position sizing. Was that the main thing that you did? Just really max out, I guess, the position sizing, or were there other things?
To some extent, yes, because it makes the difference. But let's say that I was also smart enough or lucky enough again to choose the right systems to trade in those contests, because I changed. That is very important. I mean, in the first year, I put together a mix of 4 different strategies on 4 different underlyings, and the cooperation of these 4 did the trick very well. They were the right strategies in the right place at the right time. They were good for that kind of market. I kept on trading the same strategies in 2009, obviously, because I did well, and it was a disaster. In June, mid of the competition, I was break even. So I mean, I said I can't go anywhere like this. I end up 0% if I'm if I'm not losing it. So I changed. I looked into the strategies. I understood some important things which I missed completely in the good year. For example, the strategy I was trading on the mini S&P 500, that one was making a lot of money in 2008. But, and I didn't notice that, it was also losing a lot of money because of missed trades. I mean, I had limit orders in that strategy, and sometimes the market was moving so fast that it was simply hitting the level and then bouncing, but it was not taking my contracts. So the machine, which I was using to run the system, was assuming that I was long, for example, but I wasn't in reality. And when that very position was turned from long to short, the machine thought that I got a gain, but I didn't. I was still waiting for the execution. So I noticed that I missed many good trades. Obviously, you miss the winners because if the level where you are waiting to be served is traded through, you get served and you get to a loser if it goes further down. So, I mean, I didn't notice that because I was making a lot of money. In 2009, the market was, if you remember that, quite not so volatile as it was, obviously, in 2008. And so I noticed that some trades were missed because all of a sudden, my machine was telling me I was making money, and my account was not confirming that. So I had a deeper look into that. So I said, oh, I missed this trade. Oh, I also missed that trade. What happened? Okay, I was not served. Okay, I understand the problem. But why was I making so much money in 2008? Because I was making a lot of money. The moves were wide, so I didn't notice them. I noticed I lost a lot of money because I was not trading some specific trades. I learned that. I had a workaround to go through that in the future. Just a note, in 2008 and 2009 as well, I was not trading directly off the software. The software was running the strategies. The strategies were showing me the trades to place, and I was trading those trades manually. because I had not yet the technology to do everything in an automated way. It came in 2010 with another broker, and now obviously I do so every single day. I have everything on a cloud server, and it trades with no need of intervention, only supervision, but I mean, back to 2009, I wasn't making money. That strategy was, in any case, no longer making money or enough money to win the competition. So I understood the market has changed. And the market had actually changed a lot. It was shocked after 2008. The moves now were different, like a drunk people who don't know what to go to. So I looked into the portfolio of systems that I had, and I chose some other systems, believing that those systems with a logic they were trading would be good for that kind of market conditions. And they did. In the second half of 2009, I made enough money to win that year because the new chosen systems were good. Obviously, in the competition, I had only 15 and then later on only $10,000 to trade. I could not use all the systems that I normally use in my personal trading. So I had to make choices. And those choices were manual choices. Later on, I developed software to make choices based on momentum or performance, all things like that. But sometimes you also need some gut feeling to say, this is the right thing to do now. Some experience, some luck, I don't know. So obviously to have, as I said before, position sizing is good, but you need something that works. And I was able to choose the right systems to put in the machine and to trade the right systems. 2010 again was a completely different story again. I was able in 2010 to understand the importance of diversification. So I added, for example, a strategy on crude oil, the future. Just to tell, I was not dumb before 2010. Simply, crude oil futures, such as many others, was not ready yet to be traded automatically. The market was newborn, 2007, the cloning market. And so all the moves were not clean enough to use an automated system. 2010, all the major commodities were ready to be traded also with trading systems. And I did so, adding a strategy on crude oil, simply intraday trend following strategy, and it also helped a lot. So in 2010, I understood the importance of diversifying on completely different markets, and it helped again a lot. Position sizing did the rest, but I had the right things in the right place, and I tried to maximize them with position sizing. So yeah, position sizing was awfully important, but it's not the key. It's one of the keys. You have multiple key lockers, so you need to open all of them to go through.
Yeah, understood. Awesome. Well, let's talk more about how you trade day by day and how your trading's changed over time, and maybe what you've learnt from them and what you've learnt over your extensive career doing this. I'm interested initially actually in how your mindset has shifted over the years, how your thinking about trading has changed and how it's impacted how you trade, over those last 10, 20 years.
You got to the point. 10, 20 years, this is the key. Because I believe that my mindset changed together with my mind and with my body. Obviously 20 years ago I was younger, as anybody of us, and the attitude was different. What didn't change is the passion to understand, to figure out what happens in the markets, and the possibility to dedicate my days to studying the markets is great. I mean, I can spend the time I desire to understand how things go on. And so I added stuff. I simply added stuff to what I do. My bread and butter was and is probably futures trading with automated trading systems, but always starting from an algorithmic point of view, because I want numbers to confirm what I do. I added other kind of approaches. For example, asset allocation, and I will tell you later why, and options trading. Just to go back to 2002, probably a long period ago, a friend of mine said that I was probably the right guy to trade options. because of my mindset, because of my mathematical mind, whatever. I mean, or maybe he was simply wrong. I don't know. I didn't follow his tip, and I dedicated the rest of my studies to what I was doing and to what I achieved later on futures trading. But slowly, I had a look at that, and I got more and more involved in options. And today, I'm very happy to trade strategies in options. They are not completely automated, of course, because of a number of reasons, but they are automated in terms of rules, of models, because I have measured what the outcome should be, so I know what to do if things go wrong and so on. And asset allocation is another point that I like to study because I'm thinking about, let's say, approaching the markets in a more relaxed way. I don't need to make great money. I don't need it from different points of view. Maybe somebody wants to become the next billionaire. Okay, then go on. But it's not my case.
You move more into a wealth preservation phase.
Yeah, exactly. It's more about thinking about a retirement plan or something like that, where retirement doesn't mean sitting on the bench at the river. It just means that it goes lower. The pim pum pam of futures is nice. A nice part is to figure out what to do. To leave it is a bit different because, believe me, the fluctuations are obviously there, and it disturbs not from an economical point of view, luckily, but somebody who approaches today the markets might be affected by that, of course, but it approaches from mindset, because when you lose, it's because you were probably wrong. And I don't like that. I mean, I'm not stubborn, but I understand the losses are part of the game. But obviously, I prefer to win. I think anybody does.
Sure.
So something that can be seen from a different point of view. If you invest your money, you don't expect X% per day. You just expect in the long term, your assets to grow. So you look at it in a different way. When you trade, trading is fast compared to investing. So you expect the result to come out.
Yeah.
I don't say every single day, but at least on a weekly basis or something like that. And if it doesn't, it becomes frustrating. If your investments go down, you can cope with that because you say, okay, it's fine. I know it happens. It's something that goes, it has to go. It's going the way it has to go. On trading, you feel guilty, So, I mean, I'm still trading, and also investing is trading to some extent, of course. But it changes the perspective. And the options trading is in between, because you have something that has a strategical and tactical way to approach the markets, but again, you do so waiting, because all the structures you open in options trading are there to develop a specific result. On trading, you have to guess the futures trading, the direction of the market. On option, it's more to understand how the single structures work, what affects the difference in price of a single option, things like that. You can study that, and then you can build your tactics depending on what you want to achieve. And that's different, So over the years, I became more tactical and relaxed. Obviously, it's a matter of age. I think so. I know Larry Williams is still very active, and he's over 80 now. Sorry, Larry, I didn't mean to say that, but it's the truth. But he's an exceptional trader, exceptional man. So, I mean, he has energy. I have energy as well to some extent, but I just see it from a different way. So I believe that anybody will go through this path probably. When you start having gray hair, you look at things in a different way. The good part that I always had is that I always took all the necessary time for my personal life. Well, my personal life is my family, of course. This didn't change, but also thinking about what you have on the machine while you are playing with your kids is different. Because if you think, I have to go back to see if that position went to take a profit or to a stop, or if you say, okay, I have positions which will give something in a couple of weeks, it changes a bit the way you can live the rest of your hours during the day when you don't sit at the monitor.
Absolutely. So let's talk about how you do trade now, then, Andrea. Like, you're still trading futures. Obviously, you're still a fan of being diversified and trading multiple strategies on multiple markets. Let's break it down. So, what kind of instruments and markets are you trading?
I should tell you what I'm not trading,
Right.
but okay. Futures on CME and Eurex mostly. Index futures, especially. I also have commodities and no currencies, just a few strategies. I don't like the way they move very much, and bonds, of course. Now, one step back. I have hundreds of strategies built on all these electronic markets where there are enough volumes to trade smoothly.
Yeah.
I don't want to be stuck somewhere where I can't find a counterpart to sell or to buy from. And mostly in the Globex you find any of them, of course, depending on the size of the account, but you can trade credit. So that is my field, my playground, let's say. And there I have every single market studied according to its specific characteristics. This is an approach which differs from some other traders, which is not the right one or the wrong one. It's just simply the one I prefer. So I try to identify how a single market behaves depending on the situation. What happens in high volatility, what is likely to happen after a breakout, what is likely to happen after a huge move, what is likely to happen on Mondays, on Fridays, all this kind of stuff. Then I take my market, I simulate on intraday data, historical intraday data, simple trading principle. For example, enter at a breakout of the high of last session. Very, very basic approach. And then close this position at the end of the day, after 2 days, at a take profit, obviously always with a stop loss, and these rules put together. If this very simple skeleton of a system produces results which are promising, which means I see a more or less growing equity line, which is yet not tradable, because normally if you find something which is tradable, fine, but it doesn't happen. Maybe you see something that grows, so you think there is an edge. This is something that works for that market. But this thing is not tradable because I see the average trade that you make is too small to cover costs of slippage and also commissions. So if it's promising, I work on that. I say, okay, I see that this market is good for trading a breakout of last session's high and exiting at the end of the day. Is it always like that? Or are there some market conditions where this thing is better? For example, what happens if yesterday was a very choppy day where things moves, or what happens if yesterday was a day where we saw a huge move in the markets, and we do this after that kind of situation? All these what happens if are coded in a library of patterns where I try to identify a concept of what the market did. I go through this and I analyze what happens. I don't look for the best. I just analyze and see, okay, I notice that if yesterday was a quiet day, this thing is better. I notice that if yesterday was a day with a down close to this level, this thing works better. Then the human intervention is, I personally estimate if these things make sense. Does it make sense? Not from a statistical point of view, but just, is there common sense in doing so, or is it something what is just a coincidence? If I believe, and I might be wrong, but if I believe it makes sense, I can take that rule in addition to my basic system, and I build on top of that. So I refine the original system, and probably out of the brutal system I got at the beginning, I get something that is tradable. Obviously, some markets are in any case better for a breakout approach. Some markets are anytime better for a counter trend approach, where you buy the dips or you sell the highs instead of going through a breakout. You can identify that with some simple scripts where you simulate that, and then you decide, why should I develop a trend following strategy on this market that doesn't move ever? I just develop a counter trend strategy. If the market changes its conditions because of macroeconomic things, I will notice. I will probably get some losses in the transaction period, but then I know, and I can still measure that. Measure is very important. And this is probably what I do on futures. So I collect a number of systems on different markets, each of them studied with my rules, and I have this huge portfolio. Now the problem is
okay.
huge.
So let me just stop you before you cover the whole podcast.
Yeah.
So you're building those, and we're starting to get into the weeds of, I guess, your robustness testing and your strategy development process. That's great. But across, say, the CME and Eurex, like you're willing to look at almost any market that's liquid enough. Does that give you around 100 markets, say, or 100 plus, or 70?
No. It's about 30, 40. I can put a list. Mini
Right.
S&P, mini NASDAQ, 30 years bond, 10 years bond. That you notice that.
So you're not necessarily looking at
currency.
every commodity, every agricultural soft grain.
I don't trade rough rice. I don't trade orange juice. I could trade orange juice, but just with one contract, and it's a little bit small. I introduced cocoa because it wasn't tradable a couple of years ago. Then maybe you saw it. It's a huge move, and now it's volatile and it moves enough to get some money out of it. I have trouble with corn because it doesn't move enough for my approaches. I like soybeans. I don't like wheat, the way it moves, but it's tradable. Obviously, I tried gold, platinum, silver, and copper, which I don't like. I hate copper, but I have some strategies. And natural gas, crude oil, gasoline, heating oil. Then what's there? This is energy. Live cattle, feeder cattle, and lean hogs or the meats. Sugar, cacao, coffee. Coffee is good on the softs, which, by the way, are expensive because of the data, which have extra fees to get the ICE data.
Good point.
And the index in S&P, mini NASDAQ, and on the Eurex, the DAX, and the Bund, the bonds in Europe, the Euro bond. That's it on the Eurex. I think it's enough.
Yeah. Okay. All right.
I don't recap now.
No, that's a good recap.
This is mostly what I do.
Yeah. And you've talked about building strategies specific to each of these markets.
Yes.
Now, what kind of timeframes are you trading over, though? Do you tend to create? You tend to focus on the intraday, sort of a 15-minute bar, 60-minute bar. Maybe you're gravitating to longer kind of daily data swing trading now. Do you still do a mix of all of the above? Do you try to keep diversified?
I try to mix all of the above, yes. When I was younger, I started on 5-minute bars, but I don't want to create confusion here. 5 minutes doesn't mean you trade more or you trade faster. I mean, I don't see that from a fractal point of view. I don't believe the markets are fractal. I believe that a higher definition in a smaller time frame, because you see a more detailed view of the moves, can help only to better identify entry points or to clean up the entries. If I draw a 5-minute charts bar, I still trade entering maybe once a day, exiting at the end of the day, or even one day later. The same thing I can do on an hourly basis. The only thing is that you see a better way how the market moves, and you take action earlier, because every 5 minutes you are ready to do something. If you trade off 60-minute bars, you take action every hour. So the patterns, everything changes after 1 hour. In that case, every 5 minutes there is something. It's not always necessary. So it also depends on the kind of strategies. But generally today, when I go very small, I go on a 15-minute bar. If I develop something new, I adapt it to 60 minutes because I also try to find something that works a bit more for 4 or 5 days, for example.
Mm.
So I also made experiments on 120, 240 minutes bars, and I also built something on 1440 minutes bars, which is the daily bar.
A day.
I use 1440 minutes because I want the clean detail of the close of the bar of the day. If you use daily bar, sometimes you get the settlement price on the chart that changes a bit the pattern part. So I prefer to know exactly what happened at the very last moment of the day. But the biggest part is still on 15 minutes, let's say, intraday. But again, it's just for a better view of the move. It's not faster.
Are you doing any longer term CTA style trend following where you're holding for months or years, or that's completely not of interest?
No, not on futures. You have also some problem with rolling over all the futures, which is not a problem. It's annoying simply. No, but I'm studying that. I mean, we have models. I mean, because I do it with my partners at the Unger Academy, of course, because we always study new stuff. And I'm fascinated by the idea of putting together something. But I have not found yet something which is completely satisfying. I mean, it's disappointing when you miss a huge move in some market.
Yeah, like cocoa.
Take cocoa again. I mentioned it before. It has such a huge move. It's disappointing not being in there, of course. So you try to look for something that would have caught that move. You can find it. But is that real? I mean, you can always find something that would have caught the right move. But would it be ready for the next great move? I don't know. So I'm not fully convinced of that, even though it's something that I could put in place as a diversification of the whole approach. But I don't have yet. But in that case, obviously, you would trade off daily bars or even weekly bars in some cases.
You mentioned that you didn't think markets were fractals. So can you just go into that briefly? When we're trading those smaller time frames, is it the commissions and the slippage, or do you think there's more noise? What is it that's different?
Noise. It's only a matter of noise, in my opinion. Just to tell you, I don't usually use indicators in my systems. I use indicators only as a filter for some conditions, but I don't use them as a setup, And but if I used indicators, I would just go minimum above 30-minute bars. Because smaller time frames are affected by noise, in my opinion, heavily. Just consider the range of a bar of 5 minutes compared to the range of a 60-minute bar, obviously. And then consider that how much one single tick can affect that range in a percentage of the range.
Yeah.
You understand that it's a case of fate. I mean, if it's one tick more, one tick less, many things can change in that small time frame. And not even thinking about building patterns on a 5-minute bar. It's crazy. I mean, in my opinion, it doesn't make any sense. So it's not fractal because you don't reproduce the models on a 5 minutes to a 60 to a daily and vice versa. It's something that doesn't make any sense, in my opinion. I remember some years ago, I was reading a website where the guru was teaching price action, which is something I was studying because I was interested and I was trying to understand. And then one day he pretended to have traded off some forex currency pair with his principles on a 15-minute chart. And he was describing the process. And from that very day, I stopped following that site because I understood that it was full of bullshit.
Right.
Sorry about the word. But I understood that it didn't make any sense what he was writing in that process. Because if you can believe to the whole idea of price action on a daily basis, but you will never be able to believe what happened in those single 15 minutes after 50 minutes it was simply crazy. So I understood he was just writing empty words just to catch audience or something like that.
Yeah. All too common in our industry. And that's why our podcast is just for the serious traders with no hype.
Sorry, I have to go.
Now, you also mentioned there that you don't use indicators, so that's a good statement to plow into. Are you using kind of behavioral based models, or what is it that is replacing indicators, if you like, for you?
Yeah, first of all, I just want to better clarify. I don't use indicator statement.
Yeah.
When I was young, when I was a kid, I tried to build systems because I didn't know what a system was. I thought it was a mix of indicators. There are indicators, technical analysis. So probably mixing up those indicators in the proper way, I would find a good setup to trade. And I tried all of this, and I was not able to find anything that worked. I mean, when something worked out of sample, it didn't show any profits. And so I understood that either I was too stupid, which is possible, or there wasn't that kind of edge in those indicators. So I tried to better understand the behavior of the markets. And as I said, I did so trying to simulate activity after specific happenings. So I measure volatility, direction of the markets, measure momentum. If, for example, there are 3 consecutive up closes on a daily basis, this is a pattern. What happens to my model with this? So I try to measure directly the outcome of a system with specific conditions before the entry to understand if specific market conditions before that action change the outcome of the action significantly, statistically. That's the way I measure it. Then I can put indicators as a filter. For example, I use pretty much the ADX indicator on a daily basis as a measure of the momentum of the market, the directional momentum of the market, average directional index. So when these indicators measured on a 5 days, for example, gives values which are small enough below 40 or 35, a breakout entry is much more effective rather than when it's very high. It's like if a market, when it's very high, is already exhausted. It ran too much, so it's hard to run again. Same happens to us. If you run, you to catch the bus, it shuts the door, and then this you don't get it. I mean, you do, maybe you are fit, but I can't get it anymore. And the same is to a market. When it runs too much, it's probably the time to rest for a bit. I mean, doesn't mean it won't run for the rest of the month, of the year, but at least for our time horizon, which is intraday or 3-4 days, maybe it's not the right time to enter. And you simply measure that. You put the very same entry. Then you say, I enter at the breakout of the high of yesterday. Take profit, stop loss. So now I do so only if ADX on a daily basis on 5 days is smaller than 35. And then I do so only if it's higher than 35, and you just see the outcome. You will notice that the results with the small ADX are enormously better than the ones with the higher ADX. There are exceptions, of course, but this is a rule that generally works everywhere. So this is a way I can use an indicator because, again, it measures a condition of a market, a situation. And I use the ADX mostly. I had some strategy on the MACD, which actually I didn't. I use Bollinger Bands, which are not an indicator in my opinion. Bollinger Bands are just a measure of a place, a trigger in the market. So I use them, and they are very, very good for reverse entries on markets, which are obviously good for a counter trend approach. And most often they work better than static levels, such as pivot points or extremes. So the Bollinger Bands on a 30-minute bars, not smaller, are quite effective for that. So when the prices are outside the bars and they re-enter the envelope, you can go for a counter trend, obviously with a stop loss. But this is a good setup to study and to find something that works.
When you're trading, let's call it 30, 40 futures markets, using many different strategies, and the strategies are designed for each market, could you have multiple strategies trading a single instrument on different time frames, or do you tend to just end up with one per market?
No, I do have. When is the second chapter of the thing that we started before? I try to rationalize now, limiting to some markets where the algo approach still works better because they are more mature. Let's say, just to mention one, mini S&P 500, that responds better to models, is more stable. Young markets might be good for trend following, but they last to some extent, but they change. So, I mean, you have to be ready for that. So I prefer now, as I am diversifying also on other approaches, options, as mentioned, just to keep some of them. But take the mini S&P, for example, I have plenty of strategies working together on the E-mini, and some of them are on 5 minutes, some on 30, some on 14 minute bar. And they trade together each with a different contract size, because every single strategy is a measure depending on its specific performance in terms of position sizing. And they happen to be, one is long, one is short, one is flat. So you don't have to look at the broker position because it might be flat, but you might be long on one and short on another one with the same number of contracts. And the machine knows that you are in two strategies while you don't see anything on your broker because
you're flat.
You are simply flat, obviously, because if you're long and short, you are flat. But I have all a mix of it. Some people get confused from this because they don't understand what to do exactly. If I'm long here and I have a short signal here, what should I do? Eventually, if that is triggered, you close the long position. It's just they are hedging themselves, let's say. You don't see anything on your broker, but the machine knows that you have this. And if one of the two gets a profit or is stopped, you will get again back your previous position of the strategy. And sometimes it becomes tricky because you have to be careful to check if everything is right. I mean, you look at the strategy, I have four systems, all four in position, 1 minus 2 plus 3. Yes, the maths are correct. I have the right number of contracts. Things like that.
Obviously, we just had your mate Kevin Davey on the show as well. So I want to do a bit of comparing and contrasting. I know you guys have some in-house fighting about your different methodologies, which is great. And not that there's any one right way of doing it, but he mentioned having a kind of optimal number of strategies around 20 to 30 strategies, and if he diversified on the strategy side much more than that, he really didn't get any additional value. There was not much more incremental improvement there. So curious about your thoughts on diversification and strategy diversification, and the numbers of strategies that represent a good diversified approach to you, and just whether you think part two of that question is if you could comment on the relative difference between, or the relative merits of diversifying the different markets, rates, bonds, and so on, to different strategies, diversified strategies.
Yeah, I think that Kevin is right, obviously, because he's great and we have different approaches, but in the end, we do the same thing. We have systems that work. We noticed that when he's making money, I'm sometimes losing, and when I'm making money, he's losing. So we should probably
you should merge.
put our
That's
forces
right.
together. We have talked about that, and maybe someday we merge our forces. But in any case, I believe today with my portfolio management system and so on, I end up with from 30 to 50 strategies each month, let's say. Diversified over markets, but this is not the problem. I believe that what Kevin identified from your words and what I identified is not a matter of importance of covering all the markets to find the real perfect mix, but it's more a matter of being in the right place at the right time. I noticed that regardless of the model, let's say, obviously you have a certain kind of model for a certain kind of market because of what I mentioned before. I try to identify what's best for a market. Sometimes there are periods where one specific market responds extremely well to the strategy that you built on that. Last year, no, 2 years ago, there was a great period for gasoline trend following. Then, for example, we had a great period last year on the mini Nasdaq trend following stuff. We had a great period on gold systems. There was a period on crude oil. So the point is that the diversification is good when you are there ready to go for the right period. So when you are covering different markets, you will probably have the right weapon for the market that is waking up tomorrow.
Yeah.
While if you have just a single strategy of a single market, when things don't go well, you suffer that because you are not ready to diversify. So it's more of being in the right place. You go around partying and you find the right disco where there is activity,
Mm-hmm.
and you don't end up in the party where there are only boys or only girls, and maybe only girls is fine.
Yeah.
But
So,
if they are happy.
So you've got a similar approach to him in that you would take your, let's say 20, 30 models in a given month, and you could swap those out for better performing models, rather than just let 30 models run continuously for a year, hoping that they pick up the different trends or the different environments when they happen. And some you would accept that some might not perform as well as others in certain times. But you're not doing that. You're not letting strategies run. You are substituting in new strategies and subbing out strategies that are not working. What's your process for that? Do you do that on a monthly basis or less
Yeah,
frequently?
monthly. I could do it weekly, but it's too much work. I'm lazy. Yes, more or less. In the time, I developed two different approaches. The main approach was built into one of the software that I use, Titan, where basically you load the performance of every single strategy that you have at disposal, and then this software is building sort of a ranking of strategies based on performance momentum, and is choosing the best performing to put in place the new portfolio for the coming month. It's like the coach choosing the players to go and play a game, and then you have some of a bench and so on. And you try to choose the best. This is fine, absolutely. There are some rules. Momentum performance over the last 9 months must be positive. Performance over the last 2 months must be positive. You can change this, of course.
Mm-hmm.
And for example, the last 2 months must have been in average better than the last 9 months in average. Momentum, or things like that. But you can play around with that, of course, and you have your portfolio. I used this, and I noticed anyway that was fine for specific account sizes, because I was measuring things on my account size, and obviously not all of my students have the same account size trading. And on smaller, let's say smaller, when small I mean accounts of 20K to 50K or even 200 in some cases, uh, weren't able to optimize the number of strategy, because when you have a list of good performers, if you play soccer, you still have 11 players to cover field. You can put 22. So you have to look into the single requirements in terms of margin or position sizing, in terms of maximum loss of a strategy, things like that. So you had a limited possibility to choose, and sometimes you were missing the good players. You were just missing them because you were not able to fit everything together. Things improved significantly in the last years when now we have micro futures, and you can really trade small enough, but still there was some problem with smaller account sizes. So we had a look into this, and in the last years we developed a different approach where we try to maximize the cooperation of systems and the use of all the good performing systems, which means while on the previous software we were taking every single system and measuring its maximum loss or losing day, which is the worst case scenario in our case. And we just said, okay, we have this system, that one. We didn't care about when they were trading. We have a correlation formula in our, which is not the classical correlation. I use a different way to measure correlation between systems. Just to tell you, I just take all the days they make profits, all the days they make loss, and when they work together. Because if two systems work always on different days, they are not correlated in any case. So I try to start from that, and then I build my correlation formula. But in any case, they weren't taking care of what you were doing on the market. They were just taking care of, I'm trading. But if, for example, you are, as I mentioned before, long on system A and short on system B, you don't have an exposure to risk. You are very risk adverse because you are hedged, more or less. So in the new system, the new software, we try to analyze the single positions. So we measure the time of entry and the time of exit. So we know when the system is in the market. Then we measure the direction in the market and the, let's say, the contemporaneity of trade on markets of the same instrument or of the same group. For example, mini S&P and mini Nasdaq are treated as the same, just with some correction factor. Now we can say, okay, with these conditions, we can actually put in place 5 systems instead of 1, because these 5 systems actually don't, first of all, expose you to extra risk because they never work together or they do specific conditions. And they don't obviously require specific margins to you because they don't trade together, or if they do on opposite direction, and the broker takes this into account. From this perspective, we are able to use many more systems every single month to trade, and therefore to diversify in a more capillary, better specific way. And this is of great benefit for smaller accounts, because there you can really take advantage of the best systems you have. With this approach, we change also the logic of systems deployment and exclusion, because while on the first software, Titan, we were keeping the bad period systems out, but ready to re-enter once they are fit again based on the situation. Here, when one system exceeds the new system, the Zeus software, when one system exceeds specific bad conditions, maximum drawdown multiplied by 1.5 or flat period longer than blah, 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 then this system is killed and it will never play again. Obviously, this is good because you don't take systems which are leading nowhere, which also require margin or expose you to risk. But you need to put extra stuff from time to time, because if you kill, let's say, 10 systems in 1 month, I don't say the next month, but in the next 6 months, you should add these other 10 systems, of course, new fresh systems to trade. And this is something that requires extra work, but we're here to work, because I'm not promising the lazy trader stuff where you just sit on the beach and you don't do anything.
Drink a margarita and make money. Yeah, right.
Yeah, you need to do something first to do something, and second to understand what you're doing. Because if you do everything completely passive, you don't grasp the nature of your business, and I believe it's dangerous, because you need to understand what's in your machine, what's going on, and you do so if you built that, if you knew, or that you know exactly how it was built.
So let's talk about account size, since you brought it up. Then, what's a healthy minimum account size to really do this properly? And I know that we want to make it as small as possible, but to be inclusive of everyone. But give me a realistic account size to really make a go at this. How
what
much
is
money?
The goal?
Sorry?
What is the goal? Really make a goal. What is the goal?
I mean, let's not let's be serious. Like, we want to fully diversified. We want to trade as many markets and as many strategies as possible. I guess that's what I'm thinking. We want to be as diversified.
In that case, you can do it with 20K.
Yeah,
in that
right.
case. But you can't live with that trading. I mean, 672%. Fantastic.
Yeah, no,
but
I mean, I know
it's
we're
not
not
even close to reality.
No one's expecting.
If you achieve a 30% in average, you are great. Believe me.
Yes.
30%.
Yes.
And you are great.
Yeah.
I would, if you can sign that for me, I will probably give you my money. I mean, so with that in mind, you understand that 20K lead, if you are very good, to $6,000 a year, which I doubt can afford you to
No,
live from
and I'm
that,
not talking about that. Yep, we're talking.
But you can build on that.
Yeah,
You
that's
can build
right.
on that. Obviously, this is futures trading with
Mm.
micro futures
Mm.
and with proper diversification. If we go to options trading, which I mentioned before, you can also go smaller than that. You can also get to 5,000 or so.
Mm.
But again, you can't expect the moon. You just expect something that can be pleasant because it works.
Let's
But you
just
won't
talk
get rich.
about percentages. That's right. So we're not
20K,
expecting
20K,
to...
you can work close to seriously.
Mm.
50K is much better.
Mm-hmm.
And then you can go up. When with my specific approach on futures, I think it starts getting hard if you exceed something like $5 million.
Okay, so that was my next question: is scaling up the other way? How would you change your approach at the $5 million mark, or even at the $10 million mark? Like, is there a limit to trading the shorter term future strategies?
Considering that I obviously suggest never to trade all your money because it's probably your money should be safe in a bank account invested in some very small assets. So if you dedicate 30% of your assets to trading with 5 millions, it means you have something like 50 millions and over your personal wealth. So why don't you trade? Go to the beach, a famous beach.
That's right.
But in any case, just kidding. Of course, you could happen to trade other people's money and so on. Above that, you have to add diversification of approaches. You can trade futures, of course, in the same way, but you should add that stuff you mentioned of long-term trade following futures, where you have a quiet thing. You should definitely look at some asset allocation models just to use the liquidity that you would have in excess, because the margin requires don't need all that. But it has still to make money. And with option tradings, if you consider, for example, the SPX, which is great market, you can go up interestingly also with big money there. And but also in that case, the performance is obviously smaller the bigger you become, because you start having execution problems, and so you have to go smoother in the market and so on. But you have to diversify in approaches. Don't just think about diversifying in systems, because you will end up always on the same stuff. And also, if you have 10 systems, maybe 9 of them enter at the same point because of different logics, but they still enter there, you have trouble.
Yeah.
But if you diversify in approaches, the long-term trend following, you are there, you sit there, you don't care about execution. This faster way of trading, option trading, and asset allocation. This is the proper mix, in my opinion. With asset allocation, I mean on sectors, such as the SPY TLT stuff, things like that. Obviously you can refine that. I'm not a fan of stock picking and trying to build a perfect portfolio, because evidence shows that stock picking normally doesn't beat the market in the long term. So either you are very lucky, or you just enjoy yourself in making some choices. But stock picking is something that is hard to achieve. And also, you could argument that on stock trading you have much larger volumes. If you trade Apple, you obviously can trade bigger than if you trade orange juice, I mentioned before. But it's also true that if you focus on stocks and you diversify, adding many strategies on the stock market, you probably are not diversifying, because those strategies will most probably do the same thing in the same moment, and you will be overexposed on the index in the end. That's why I prefer to trade the futures and the index rather than the single stocks, because stocks more or less, when things go mad, they do all things the same way. Together. So you find yourself in the same conditions, and this is not safe. So I prefer to go for sectors, so with ETFs or things like that.
I know some time ago you weren't trading any crypto, but crypto futures have been out for a little while now. I know there's not a lot of data technically, but have you started trading Bitcoin and Ethereum futures?
I'm trading the micro Bitcoin future on the CME, which is still on the regulated markets. The micro, first of all, I traded the micro because it's much better in terms of volumes and also on spread, because the spread is pretty large, so it becomes expensive to trade the the cryptos on interactive brokers where I trade. I don't know if I'm allowed to say that.
Of course, no,
I do
it's
so.
fine.
And the big Bitcoin future is too expensive because of the margin requirements. It's equivalent to 5 Bitcoins. You understand this?
Yeah.
It's a big thing. So I don't like that very much. On the crypto markets, going to the exchanges, so I did something. I'm too old, maybe. I don't like that. I mean, I don't like to trade there. I don't see the necessity, because I would still need to make it worthless. I mean, to make it worth it, I should trade enough. And to be sincere, I don't trust putting too much money on an exchange. Just this
On
is
a
my
crypto
personal point of view.
exchange, yeah,
I have
we're
nothing
talking-
against that, but I don't like that.
We mean
So if
crypto.
you keep it as a hobby, okay, it's fine.
Yeah.
But just to invest in that, I don't feel confident. If I have to invest, I can invest in cryptos as an asset. I will put them on my ledger, keep them there, and it's fine. But it's a different thing, you know.
Yeah.
That way you can anyway do some cash and carry stuff, which is interesting because you can take advantage in some moments of the difference between the future price and the underlying. And you can do it also with some leverage. So if you have your Bitcoin on your ledger, for example, you can go short on the futures, just putting a small amount of those Bitcoins in the exchange and benefit from that difference, which can also lead to interesting performances, sometimes also 20% a year, which is interesting, of course. But again, to make it serious, you need money. If you just want to play around with it, it's fine. But it's my personal opinion. I mean, I don't want to. I know there are many people. You are old. Okay, I'm old. I got old.
Yeah, you're still alive and you're still trading, and that's the most important thing. You survived it. But just on the crypto futures, there's a very limited amount of historical data there. It's also very unique data. There's been some obviously extreme moves. What was your approach to building a strategy for Bitcoin futures with that data?
Well, it was very simple. I mean, I had enough data because not of the it's old enough if we think that if we get data from 2016, 2015,
sure.
From Bybit, you get some interesting data. But the problem is that this market change enormously, of course. When you have a hype year, anything you buy, you make money, you know. So you don't really need a strategy. But I obviously chose a trend following approach. And I noticed that in the past years, overnight stuff worked very well. As of today, intraday is better. Most probably because the conditions don't last long enough to benefit from the big trend. Of course, when you get the big trend, it's there.
Yeah.
But the big trend is not every day there. So it's better to trade intraday as of today. You have enough move to benefit from that. And trend following. I have some swing trading strategies which could be applied also to a portfolio of the most important tokens. So you can do that on your systems. But we have also you can do it on cash here in Italy because we are not allowed to trade the futures everywhere. We have some exchanges which allow that, but the bigger Binance, for example, doesn't allow us to trade the futures. So we are limited to some extent. And the swing trading approach, which is still a trend following somehow, works best if you can also go short. And you can do that on futures. On cash, it's a bit complicated, you know.
Yeah.
So that is the only approach now to dance in the crypto market, let's say, which is a swing.
So I'm interested. You mentioned Titan. I'm interested, and we're jumping all over the place, but that's all right. We'll try and cover everything still. So you mentioned Titan. I'm interested in your tech stack, and I want to come at it from this angle, right? So I'm not someone really familiar with trading in the exact way that you're doing it, where strategies are moving in and potentially moving out, subbed in, subbed out on a monthly basis, say. My question about that is, Andrea, how do you backtest that? Because let's say I build a system and I backtest it and I get familiar with it, but then in the live running of that system, I don't just run it continuously. I turn it on and off depending on the performance with the rest of the portfolio. And so, how do you get comfortable about this environment? Can you backtest this whole process?
Yes, of course. We start with the very same data we collect on the platform for the very single system. So we download the daily profit and loss starting from 2008, and that's all inside. And then the system works and gives us the exact combination we had in that specific
Okay.
month of 2012, for example, and so on. So we see what works best, and obviously we have always a look at the bad periods, what happened when things went mad.
So the
in the
rules
market.
for which systems come in and which systems come out, they're also programmed into the backtest so that you can
Yes.
backtest a
No,
whole
if the software which chooses the system itself is always on. And when we collect the data, it would have performed, and we analyzed when that system was working. We take only those results, obviously, and when it was sitting and waiting, those results are still collected but are not calculated into the performance we would have achieved. So it replicates somehow the real life conditions we would have had with slippage and all things that we put into the environment.
So is this what Titan does? Tell me what Titan does.
Both Titan and Zeus.
Titan and can you explain
well, I
those?
have all my, just to tell you the way it proceeds, maybe it's even a bit complicated. We have all the systems on the workspaces with all the single systems, with all their performance, starting from the night of the age. And they download, each of these downloads a specific text file where you have a CSV file, where you have all the dates, day by day, and the profit and loss, and then the trades. These number of text files are eaten up by the software, who builds a big matrix. We use MATLAB to build this, and then it elaborates all the combinations to give us and deliver the end performance, considering only those systems that from time to time were active in the market. Both do this, Titan and Zeus. The difference is they decide which system trades based on different rules. In one case, momentum and risk. It doesn't look too much at margin requirements. The second case, momentum and requirements based on risk and margin. So it's Zeus is, let's say, having a look at the best combination possible, still limiting risk and limiting the margin requirement, because you have to have enough money to trade. Titan was just taking care of, okay, position sizing. You have so much money, you can trade this. You can't trade that because it's too much. Zeus says, no, wait, it's not too much, because look, that system never trades together with that one. So it doesn't require extra money, doesn't expose you to extra risk. You can do it. Titan didn't do that because it didn't care, because it was starting from an idea of more money at disposal.
So Zeus is like the upgraded version?
A different approach. Yeah, it's an upgraded version, considering that we have many students who trade with 20K. So we had to have something that was, let's say, more in line with their specific requirements. But I can tell you, I prefer this, and I use Zeus now. Also for my personal use, I prefer the way it puts things together, and also the analysis I can run.
So can you, or do you optimize over all of those strategies over history to see what is the best rule for when a trading strategy should switch on and switch off?
No, normally I don't. I did some. First of all, there is no specific optimization tool in the software. You have to change the conditions by hand, and then you can run the simulation, which is fast, but you have still to change it. But I did want to avoid the optimization routine, because it just exposes you to overfitting in that case, in my opinion, because you have to think about the logic. And the logic can be good and can be worse in some cases, but it has to be a good logic to use, and that's it. So the logic is momentum, performance, and that's it, let's say. And then the rules, you can say, okay, I stop a system, I kill a system in Zeus when the drawdown in auto sample is more than 50% of exceeds by 50% the historical drawdown. You can play with it and say 60, 40, 55. But I think it's tricky, so just say something. It must be much more than what you had in history.
If you've got $100,000 to devote to futures trading using these short-term approaches, how many strategies do you need to have developed before you can really start to use this software and make the most of it? Obviously, you need more than
Well,
two
I believe
or three.
you have to, with 100K, considering micro futures, you would at least have 100 strategies to get from, pick from the ones that you would trade, which will probably end up being about 30.
Yeah, okay. So you probably want 100 strategies and you probably want at least 30 plus instruments.
No. Instruments can also be about 4 or 5.
Oh, okay.
But you need different strategies on each of them.
Yes, so you could.
The point is that you have if you have 5 strategies, for example, you don't need the software. You can do it by hand. You don't need something that does the job for you, because it's something that you can do. It's not time demanding. But if you have 100, you get mad and crazy doing that thing. So you need some software that is able to scramble data in a much more effective way than you as a human being do.
And to be clear, this software is only available to your students, isn't it?
Yes, it's in the program. It's part of the program because, in theory, in the program, we explain the principles on how you can use to manage the portfolio. And then we say, these are the principles. We have also this tool that could do this job for you. But in theory, you could either do it manually. If you have 5 strategies, you do so. Or you could build a tool on your side, because maybe you are a developer and you do it better than I did, and this is what we use, so you can have it. To sell it to somebody who hasn't the knowledge on how we think about things would be useless. If I gave it to Kevin, for example, who develops things in a completely different way, it would be completely useless.
And just to complete the picture of your tech stack, you're doing, I guess, your strategy construction and your execution in MultiCharts. Is that correct?
Yes.
And what's the portfolio testing like in MultiCharts? Because I know they make a fuss about having some portfolio.
I just used it in some rare occasions, but I don't really like that too much. Sometimes I use it to have the data in the same format I have on the single performance reports. But for example, already if you add futures of different markets, you have to work on a local time instead of exchange, because you can mix futures on different time zones. Chicago and New York aren't compatible unless you move to either one of the two, or here in Italy, you put everything in local time and then you get that done. And then you have to build the rules of money management. I don't say I don't like it, because I used it actually, but the portfolio stuff, I prefer to do it with my tools.
Okay, let's talk about the meaty stuff. I'm interested in what your process is for strategy creation and robustness testing, and then I want to talk about portfolio, bringing this together to a portfolio. So I know we've already touched on a lot of this in part, but I want to contrast what you do with, say, Kevin Davey and Bob Pardo, who we've had on the show, talking about walk forward analysis. So let's talk a little bit about your process for validating strategy robustness. What's your approach?
Well, first of all, I don't do walk forward, not because I'm against walk forward. I can tell you that I'm studying a way to use walk forward in my process, but simply because walk forward, as it is, cannot cope with the kind of parameters I use in my strategies. It doesn't make really sense to do it the way, because, for example, the list of patterns is not a continuity list, it's just a list. It wouldn't be effective to look into which pattern is the best for 1 week or so, and then it doesn't simply work. And Kevin knows, he agrees on that.
Yes.
So normally, well, it's not what I do, what I recommend to do, which is important, because what I do obviously based on experience and gut feeling and so on. But normally we develop a system on in-sample and we look at the out-of-sample performance. But we have also a tool which is called validator, where we can play around a bit with some parts of the code and the results, so that we can change a bit of again the parameters, just to see if we are in a stability zone or not in the choice of the parameters. If you just didn't cherry pick the best result, and then if you move left or right with any percentage, you get down with performance. So we do so, and we also have in this tool a way to change a little bit the prices of the markets. Again, as I mentioned before, we study with our patterns what happened the day before, and the patterns are built of market data of the day before. So we try to see, okay, but what if the high of yesterday would have just been a bit higher or a bit lower, and the open was 10 ticks above or 10 ticks below? Maybe the pattern changes, and maybe it changes to an extent that leads to a different performance. So we also play with this to see how stable the performance is, changing a little bit of the market conditions. And doing so, we get some group of equity lines, and we see in which percentile we are, if we are in the middle part or if we are in an extreme. And obviously cases where we are at bottom up or bottom down are not something we like, because we know we are very unstable, we are in a zone which is not what we could expect then in real time. This is more or less what we should do. I don't do that, I can tell you, because today when I develop, I have a feeling based on experience if things are real or not, or can be real or not. I don't guess if it's real, but I see if something makes sense. First rule, if it's very nice, I don't believe it.
Too good to be true.
If I get something which is too good, I don't believe it, and try to find the mistake.
Yeah.
Sometimes you have mistakes. And obviously, we have all a number of analysis and tips to be careful about in developing, because there are tricks where you can get completely false equity lines, because the machine is not able to analyze data in the proper way. So we have to be careful of that, and we always say that to our students. For example, if you take Renko bars and you plot a chart and you put some strategy on that, momentum, the pre-built strategies you have in MultiCharts, you find dream equity lines. The problem is that you cannot use trading systems on Renko bars, because Renko bars change during the moment they are built. It changes completely. So you can't do that. And what you see is not what you were seeing during the live trading. But the results are always very nice. So those are things that we try to put in light and to tell you to be careful about. So again, robustness is based on changing a little bit the condition and to see how stable the situation was in the choice that you made. This is for the single strategies. And in the portfolio, again, as I mentioned before, I have some basic rules which make sense. Basic rules based on momentum performance and on ranking performance. Obviously, ranking at the same level. So I don't compare silver to corn. We do so comparing with a proper number of contracts, because silver would always perform better than corn if we look at the single contract strategy. But we try to equalize all the systems and then to analyze which one is the best performer, so that we can create this ranking to use when we have to decide the ones to put in place.
When you're building these strategies, Andrea, do you tend to just test with a single contract in a back test first, or
yes?
Because let's talk about position sizing, and obviously a lot of the people we've had on the show, fund managers, CTAs, longer term guys with the trend following we talked about, they'll generally have a principle of equal bet sizing. And I know you're into this and you've written a book on position sizing, but the general principle is that one should should risk the same amount of dollars on every trade, or same percentage of your account on every trade. So can you do a back test like that, or do you tend to do the back test just one contract at a time, but then your risk is
Now, on the
changing?
single strategy, I always go with one contract with no commissions and slippage calculated.
Mm-hmm.
I just want to find something that works. I want, as said before, good things to then apply position sizing.
When do you?
So I
At
want a
what
good
stage?
strategy.
Yeah.
I don't calculate the costs in the development because I want to see the big picture.
Mm-hmm.
Obviously, I immediately look at the average trade of the performance, because if I get, let's say, for example, on a mini Nasdaq, a strategy that has $80 average trade, I know it's not tradable, because real life trading eats up that with commission slippage and so on. So I know that. I know more or less what are the levels which could be acceptable and so on. Then the results that we print in the TXT file that I mentioned before are again with one single contract. When we treat them in our software, we add the costs of the market, and we also use the position sizing to put everything at the same level, more or less. And position sizing is built on the worst case scenario, which is our risk. On Zeus, we also have a possibility to change the daily worst case scenario and look at the worst drawdown as a measure of risk. I prefer that one because it's more stable now. And obviously, you decide based on the worst case scenario of your system how much that worst case scenario would impact on your balance, and you decide what percentage you allow that to hit for each contract. So if you say, I don't want to be hit more by 1%, how much is the worst case scenario here? It would impact as a 0.2%. Perfect. I can use 5 contracts. 1% is what I allow, 0.2, 5 contracts. If worst case scenario, I don't want more than 1% loss per trade. My worst case scenario is 1.3%. Sorry, I don't have enough money. I won't trade that strategy.
Right.
So this is more or less the thing that we...
So the general principle is that when you do that first test on a single contract, that usually does translate. Like you've got enough of a feeling from that to know that it'll work, even when you change the position sizing. It's not going to substantially change the cash flows of that strategy and make it a completely different strategy. A single contract is sufficient for you to get a feel for it, and then you go from there.
Yeah, because I just want a model that works, and then I will use that model in a proper way. It doesn't change if you add contracts, unless you trade on a very small market and then you have trouble, but I exclude the small market. Orange juice is not something I consider. I have nice strategies on orange juice, but I know that if I would trade with more than one contract, they would be destroyed. So it's useless, you know. But in any case, if you have something that works with one, and you know you can use it with 10, you just take it as is, and then you decide how much to put on that depending on your risk condition, which is a different way to go. But you need something that works.
When you're building these strategies, like one strategy per market, so you've got an NQ strategy and an ES strategy and so on, how do you... what's some of the other methods that you might use to make sure you're not overfitting for that one market? And I want to ask if you do some testing across multiple markets to confirm robustness as well, or...
No, I don't. I do sometimes just playing around, but I don't do it as a procedure, because considering that I try to identify the characteristics of a market, it would be useless to see if that works on another market, because if if I prepare a specific dish for a friend of mine who is a vegan, a convict vegan, and I know he I wouldn't offer that to a friend of mine who makes a barbecue every day, because different conditions, you know. So I know, but in the portfolio strategies, I can consider also some systems that work on specific models which are far from the specific market condition. When I look, for example, at the long-term trend following, I don't care about the specific market. I just put a rule, and that rule must be valid for every market. In that case, I use a portfolio trader of MultiCharts because I put everything together.
Right.
Because I want to see what happens if I put everything together, because I want everything to be together. There are no filters in that case through Titan or Zeus, because you need all the markets to be there ready to go for the long run if it's the case. But it's a different way to consider it. It's not my Unger method, let's say, because it's something that is another way to trade. And in that case, yes, I look across the markets and I try to find something that more or less is good for all the markets. But in my specific approach, no, because I try to tailor suit for you. And if I test it on myself, pretty fast, it doesn't work.
Yeah, understood. Makes sense. So let's start to wind up and just talking about your portfolio construction, which we've obviously been talking about. But one thing maybe I could get a clearer picture of is as you're determining which strategies to combine together. We've got 100, we need 20 to play together well. Explain to me again, perhaps, the way of checking, like, and I presume this is one of the more important factors, the non-correlation between the strategies. So
Well, no correlation in my way is I look at the P&L every day. And then I look only at the days where the two strategies produced a P&L on the very same day, because they were working together. I don't care if they are correlated or not, if they work one on Monday and the other one on Saturday or on Friday. They are not correlated, obviously, because they are doing things in a different way. So I look only at the days where they both produce a P&L. It means they both worked. Then I look on all of these days. Let's say I have 300 days history. On 150 days, they had a simultaneous P&L on that days. So I take only these 150. And in these 150, I look at all the days where the P&L was of the same sign. I don't care if it was plus or minus, same sign. So how many of the 150 days produced the same outcome in terms of negative or positive? 50? Perfect. 50 divided by 150 is 0.3, more or less, 33. I don't consider this as a correlation. I mean, I have a limit, which is 75. Or you can put it the way you want.
Right.
And if it's below that, I don't care.
Yeah.
If it's above my threshold, then I do the following. Let's say it's 90. They two together would produce 180. 90 plus 90. So I say, okay, well, listen. They are similar. They are not identical, because it would be 2. You double your exposure. You just have 180. 1 plus. So what do? I calculate the contracts of each, and then I simply divide the number of contracts by 1.8. And I trade both with that number of contracts I obtained. If it's too small, I don't trade, of course. Let's suppose you can achieve it. So I still keep the benefit of using both, because I believe both are good, because I got good performance. But I don't overexpose my portfolio to the possibility they both go bad in the same day. So I just reduce, so that it's like if I had just one, based on the principle that makes them correlated.
Yeah.
This is what I did, because I didn't find a real benefit in the standard correlation that MultiCharts, for example, produces. And I heard one day, I was talking to a friend of mine working for a hedge fund, that they do the same, looking at the P&L correlation in the hedge fund. So maybe that hedge fund is a disaster, or maybe it's a good idea.
Yeah, I think it's a good idea to look at the actual return streams and the correlation of those return streams, and the way you're doing that is quite novel. I like it. So, okay, and then we've talked about how you move new strategies in and out, and that's largely this performance-based
Yes,
review.
positive. The ones who are promoted based on performance, position sizing. Only this portion of the ones can be traded because the others, sorry, but you don't have enough money. But the list is ranked on performance. So you have the best on top of it. And among the best, you take as long as you have enough money to trade. Enough money is measured on margin and risk, and risk and margin.
Do you find that, so with risk versus margin, or like let's say drawdowns versus margin requirements, which tends to be the one that maxes you out more often? Like, which is the limit that you would usually hit, margin or drawdown risk?
No, drawdown risk, because the list is already cut by the position sizing algorithm. Because when you apply position sizing, you already exclude a number of systems because they are too risky in that moment. So you go only in the one who are affordable, let's say. And with Titan, on my side, I can tell you that I was not using more than 30% of the margin normally trading. Now here we try to maximize because we want to benefit those who have smaller accounts so that they can trade extensively. But again, we always start from risk because risk is the first thing I want to control. And then I don't want to see my legs cut by the margin. I have to measure that. And also consider that margin is tricky because obviously we don't have in Zeus all the margin history of all the instruments,
right? Exactly.
All the days. We make an estimation on margin based on the volatility we have in the markets because we saw that estimation matches more or less what the broker applies and so on.
Which makes sense because that's roughly how the margins are set.
Yeah, of course. So we made that kind of analysis based on ATR, volatility, and so on, and that is the estimation of the margin requirement in a specific period.
So is this whole process fairly streamlined for you now, like the strategy creation, the robustness testing, the moving in, moving out portfolio creation? Like, is it like a workshop for you now where it's quite automated, the whole process, or it's still quite a thoughtful, logical based process to build up the strategy and test it?
As of today, for me specifically, I have to see it as a hobby. Well, the portfolio is a routine. Every month I go through that, the first weekend of the month and so on. But it's automated. You go through it. It's not a big deal. The strategy creation is something I do now based on if I get a bit bored in other things, I develop strategies. If I have an idea, I develop a strategy. But I don't do it as a daily bread and butter any longer. I have good stuff. I take advantage of it. And when I have some idea, I test it and I go for it. But I don't have a specific task. I noticed that on the student side, it's much more strategy development oriented. And okay, many of them also take the strategies that we put at their disposal we show models as an example that work. So many of them take these and based on that, they just make some changes and they use them for their own. So they cut down all the development process. But obviously, we have contests, monthly contests, strategy of the month, where we evaluate strategies sent by the students. And I can tell you that there are some guys who really do a great job out there. So you see that they work hard. The last winner won developing a strategy on gold, which took as an example one of the articles we wrote, I think, on trading stocks and commodities. And based on that article, he was able to develop this system that is a very good system. So just to show you how people are curious, and those are the kind of persons who will probably succeed, because it's true that we give them whatever is possible to make them succeed. But if you are not committed, and if you don't even consider that you have to work to build your infrastructure in terms of system, environment, and so on, I don't know how long you can last. Because if you just take what I can give you without looking at it from a critical point of view, Maybe you get a very good period, maybe you get a very good long period, but in the long run, I don't see stability in what you're doing. While if you get advantage of what I'm telling you, showing you, and you digest it your way, maybe you improve it, then you really go for it the way that you as any student can cope with the best way possible.
If you're not using that walk forward process, do you do any updating to parameters or the like as your strategies going through a life cycle?
I did so. I tried to do so in the past to notice to my disappointment that some months later the original strategy performed better than the revised one. So no, today the systems are killed by Zeus, or we just throw it away for other reasons, and I develop a brand new strategy. I never take an existing strategy, twisting around with it and playing around to reshape
Try
it,
to fix it. Interesting.
with some Botox. No,
Yeah.
I try to
Pretty
avoid
it up.
that because I noticed that it's more in the direction of overfitting than real development. Of course, if a strategy died completely, it's better to throw it away. If you just see that it's a bit sick, you can look at the principle on which it's based and then forget about all the filters and build on the principle.
Yes.
That's something that is possible. But it's not a reshaping, it's just a restarting from scratch, knowing that scratch in any case was promising, which is a bit different,
Yeah, okay. Andrea, have you got a preference for a certain strategy type, like mean reversion or trend following, breakouts? Buying on limit, buying breakouts, or do you purposely try to
Depends
mix
on the
things
market.
up to
On
keep
the
it balanced?
E-mini S&P, I prefer buying on limits, counter trend, even though there are periods where it's also trend following. But I have both strategies. I prefer that one, and I can tell you that while trading both, when I see a breakout entry on the E-mini, I start feeling bad. Maybe it makes a lot of money and I'm happy, but it's against. I was born and I grew up in a mean reverting market of the E-mini. So when there are periods where it changes the nature or when there are the good conditions to go for a breakout, I accept it, but I can't look at it in a relaxed way. So, and for example, in other markets, I prefer to go for trend following. Instead of a micro Bitcoin, I go for trend following because I could develop and find a counter trend strategy probably, but it would be very dangerous because I think it would be very unstable. We have a strategy, a large drop. It's called large drop on cryptos. And as the name can suggest, it works. It enters long when there is a large drop in the market. And it makes money. It works. But believe me, it is a large drop. So actually, it's not a real counter trend. It's more like a bounce, a dead cat bounce or something like that.
Yeah.
And it works, but it's not the basic principle on which I work. Cryptos, trend following. Mini S&P, counter trend. Mini Nasdaq, both. Lately,
so it's entirely determined by the market you're looking at. You're not trying to create a balanced risk profile, say, of mean reversion plus trend following, some things with high win rates, some things with...
Yes, I try, but I always try to do so using the proper markets to use in specific conditions. I don't take the same market and build a trend following and a counter trend. There are markets, EuroFX, for example, you can find both.
Yeah.
But generally, I say, why should I use these two methods on the markets where only one is really effective and the other one is forced? I use this other method on the other market where it's better. It's like on football. Come on, I mean, you put Vlahovic in front of a goal of your counter team, and you put Buffon as a goalkeeper. You don't switch them.
Yeah.
So you try to put everybody in its role to do things properly. So it's natural. I mean, and the same thing I do. The difference is that the markets change from time to time. And when they change, normally you lose money. But if you do everything properly, you can keep this under control and you can be ready to face it the best way possible.
Makes sense. Andrea, we really better wrap up. Why don't you take us out by giving me an idea of what the students in your workshop come away with. So they come away with this software, which sounds super helpful. What's the main objective of going through this workshop?
To become a new world champion. No, to become somebody who can trade the markets knowing what they do. And
is it starting from absolute beginner, or someone usually has to have a little bit of knowledge?
More or less, we have stuff also for beginners, yes, and then slowly they grow up. Let's say on one side, we try to give all the support and the keys to go through all the process with a minimal effort. On the other side, I don't like this because I want effort from the student. It's not because of commitment. It's just because of what I mentioned before. I don't want passive students. I want people who take the contents and make them their own.
Yes.
So in there, you find all the process I went through in my years and why I do things the way I do and what I do exactly. We give all the tools to reproduce that. And we hope people build themselves to reproduce it properly or to improve it again, to improve it. I had students who are incredibly good. One of the winners, I don't mention his name for privacy reasons, but he won in 2017, so you can look at the board. He is a great student. And this guy, when I met him the first time, I noticed that he was one who was very active in the market. This guy is incredible. He's a very great source of knowledge and commitment, and he enjoys what he does, and he's great. And also, one of the last winners is great, and he started a hedge fund on his own.
Yeah, right. I was going to ask if any of your students had started hedge funds.
I can tell you sincerely, I don't know if in his hedge fund he uses exactly the principles that he learned from me. I can tell you that. He's also a student of Kevin, so maybe he does everything that he learned from Kevin. Or maybe he does both, or he does his own stuff. It doesn't matter.
I should get him on the podcast and I'll settle this.
I can tell him that you are interested in talking to him. But in any case, the point is that it doesn't really matter. I mean, I'm not convinced that I have the knowledge and that what I do is that what works and all the others are.
No, but the basic modules, I believe that the basic outline of the workshop is, I guess, getting familiar with some of these different strategy types, position sizing and the back testing that we've talked
normally
about.
when you talk to somebody, I would like to do algo trading, but I don't know how to build a trading system, not from a development point of view, but from an ideas point of view. So in that case, I can give you all the tools to find the ideas and to build your trading system. But again, when you see that I have also a number of systems that already work and so on, you might be a bit lazy and take stuff which is ready, and then I don't like this. I would like people who are not only the next workout winners, which happened. It doesn't really matter. People who are happy and who say, "Look, I did so." We have some students on a mastermind class that we have, which is just a private coaching model that we have. And these guys are incredible. I enjoy every single session I have with them because they always tell me what they did and I see how they work. And it's something that I like because they show how committed and how they are enjoying what they're doing. Apart from the results, which obviously come, and which is something we all work for.
How many years do you think the newbie trader these days has to give themselves to become successful in at some level?
I'm still learning. No, just kidding. I'm still learning in any case.
Of course we are.
But no, I believe that it depends on the time that you can dedicate. We have a program which is from 0 to trader in 8 weeks, which goes through the infrastructure part and the strategy building part so that you can go live. But this doesn't mean you are a trader internally. You are a trader, shaped as a trader because you are trading. You are doing so. But then you have to develop all that feeling that you need, and that takes, I think, at least 1 year is needed. to understand that you can never trust what you are doing enough.
Yeah.
And this is there because when you trust it too much, you might take too much risk, which is dangerous. But to go live is simple. You can, if you take the necessary time, you can build everything properly and you go so, and you feel that you know what you're doing. But then you have to learn all the shadows that are in between, and that takes time. And if you like it, you will really never stop learning because there are always new things to learn.
Awesome. Andrea, we better wrap it up, but I really appreciate that, and super helpful. There's a lot in there. It's like drinking from the fire hose. So people will have to watch this one twice to get everything out of it, I think. But yeah, thanks once again. Is there anything else?
I think they can interact.
Missed?
So if they send you questions, I can also answer them a second time if they want.
Yes, well, for sure. I'll put that out there on Substack. If the Substack's the place to go to get involved in the community and ask questions, and for sure put questions on for Andrea, and we'll do a question and answer. Ask me anything with Andrea follow up. Awesome. All right. Well, thanks once again, Andrea.
Thanks, Simon, and thanks to all the listeners. I'm sorry for keeping you all this time.
No, that's brilliant.
I hope you enjoyed it.
Fantastic.
I should remind
Thanks
you
again.
that the conversations on this show are informal and for entertainment purposes only. Certainly any general advice you may hear is obviously not specific to your needs, goals, or objectives. So nothing discussed on the show should be considered as investment advice. If you want that, you'll need to actually do your own research and speak with your financial advisor. Remember, trading can be extremely risky and past performance is not necessarily indicative of future returns. If you enjoyed the show, please subscribe or leave us a review, and if you have any questions or feedback, we'd love to hear from you. Bye for now.